Sorry, I pressed it. Okay, yeah. So what you get out is not necessarily strongly related to what you put in. That's true with exploration, because you can put a lot of money into exploring, but you might not necessarily find anything because there is some element of chance there. Or what you find ends up coming in so far down the track that you really wonder whether it's a worthwhile investment. I remember when I was looking at mining companies for some research, probably about 10, 15 years ago, one stuck in my head where a company explored for, I think it was magnesium, but don't quote me on it because it's a long time ago. And what they did was they explored for it, and they found some in the ground. And they did, one of the things you do if you think you found something is you do what we call a technical feasibility study. So you look at the possibility of getting this resource out effectively. And if it is technically feasible to extract the resource, then you do a bankable feasibility study. In other words, put dollar signs on everything. And you know how the prices of resources change. It might not necessarily be economically feasible, even though it might be technically feasible. And with this particular company, they did a technical feasibility study, bankable feasibility study. It was not worth getting the resource out of the ground. So they sat on it. Then they did 2 or 3 more feasibility studies. They did one at year 7, and the economics still weren't working. And then in year 12, they did a bankable feasibility study, and suddenly the price, it's not suddenly, and at this time, the price of magnesium was at the level where it was economically sensible to extract. So both in terms of how much you get and when you get it are loosely related to the amount and timing of the investment that you put in. And you can think that agriculture is probably similar to that. With agriculture, what you get out is not necessarily related to what you put in. You could simplify the idea of sheep farming, and you could say, well, if I'm a sheep farmer, I just need to let them wander around the grass, and then, in a few months I'll have a sheep. It's not as simple as that. You still need to, look after them and vaccinate them and all that. But if you look at things like trees, you might have a tree plantation that you're intending to get some wood out of, and that's not going to pay off until quite far down the track. In fact, you probably remember the study I mentioned about earnings reaction, stock price reactions to earnings. That was by Ball and Brown. Phil Brown, with a bunch of his mates, bought some land. They bought a tree plantation outside Perth. It was either he's still doing his PhD in the 60s, probably in the early 70s, I think. And, it was a long-term investment. It was basically their retirement fund. And it was quite a way out of Perth. But this was the early 1970s, right? And Perth has grown a lot. And so what happened was they were expecting that when Phil retired, and Phil retired about 5 years ago or so, so that's 40 years later, he'd get to sell all of this and, you get some money for retirement. Turns out that Perth expanded so much that they were no longer interested in trees. The land itself had increased in value. So I think the point I'm trying to make is a whole ton of other stuff happens in between making the investment and getting the outcome. And that might be stuff that's related. It could be bushfires, could be things that are unrelated, or like the nature of the investment changes simply because of where the land is. Okay, so they're similar in that the payoff is pretty far away from the original investment and possibly unrelated to it. They are different, however, in the accounting. And what we're actually going to see in these 2 accounting standards is 2 quite extreme outcomes. I think I've spoken enough about exploration in prior weeks for you to know that that's a political standard. We're spending money on exploring for resources, and the question is, where does the debit go? Right? So the credit goes to cash, the debit goes to, the credit goes to cash, it goes to accumulated depreciation, it goes to wages payable. Where does the debit go? Is the debit exploration expense on the income statement, or is it an asset on the balance sheet? And as I've mentioned a few times before, The amount of lobbying that happened in the 1970s meant that one option is to put that debit on the balance sheet. So we're going to see a situation where we are allowed to record an asset that you and I would probably all agree isn't really an asset. Okay, so that's the freaky thing about exploration expenditure. Agriculture is totally different. Agriculture is sort of the ultimate application of accounting theory. The short answer to what you do with agriculture is that everything is measured at fair value less cost to sell. In other words, we're going to track things at something that looks like market value. And there are really no exceptions to that. And any changes in those market values, no revaluation surpluses, nothing like that, everything goes to the income statement. So this is a fairly straightforward, pretty clean standard. Okay. There's one more point. No, I'll make this point a little later. Okay. So just make sure it's still recording. Yep, still recording. Okay. So what we've got is, the big picture is we've got managerial incentives. I talked enough about why managers who are in a mining exploration company want to record the debit as an asset. And the incentive was primarily related to, making sure your risk measure on your balance sheet, your debt to asset ratio, didn't freak out. So it didn't cause your contracts to be essentially, hang on a second, didn't cause your contracts to be violated. But even if debt contracts were there, there's still an incentive to put the debit on the balance sheet instead of on the income statement if your management reward contract is written without taking this into consideration. Because clearly, if you've got some debits, you'd rather not have them going into your income calculation, at least not until you've got some revenue to offset them. So we know that the incentives drive some of the choice in mining exploration expenditure. And the regulation is trying to deal with that. It's trying to say, well, look, we had all this lobbying in the 70s. It meant that companies are allowed to record an asset, even if most normal people say, look, that's not really an asset. But we want to make sure that users of the information have sensible information to make decisions. So the key bit of info you need to take away from the mining exploration part of today is there's a special account name, exploration and evaluation asset. And you have to use that in certain circumstances. And when you and I see a balance sheet with exploration and evaluation asset, that's an asset that's recorded when we're not sure that we found anything. So there's a guarantee that that is what the bullshit asset is called. So if managers record this debit on the balance sheet, it's a bullshit asset because they haven't found anything. That bullshit asset has to be called exploration and evaluation asset. And we'll see a paragraph later where as soon as you know that you've found something, in other words, there is actually a resource, you move out the debit out of exploration and evaluation asset. So it can't be called exploration and evaluation asset unless it really is a bullshit asset. An asset where you've spent money, but you're not sure whether you've got any future economic benefits, right? So anyway, I'll talk about normal accounting standards later. Okay, so let me just move forward. Okay, so look, I don't need to justify that. I think mining and exploration is quite important in countries like Australia, Canada, the US. And so for Australia, this is quite a significant, how you account mining companies is quite significant. Now, a point that I want to make that might not be clear, at least for people who haven't looked at this standard for 20 or 30 years, which is not you guys, we used to have a standard for mining that covered everything in the mining industry. But that's actually a pretty stupid thing to do because most things that happen in the mining industry are pretty straightforward. Property, plant, and equipment, we've got a standard on how you depreciate that. Intangibles, we know how to deal with that. Inventory, we've got a standard on that. So this is not covering those parts of the mining industry after you've found stuff, you develop it, and you start mining it. This is covering solely that period where you are exploring for resources. So this is all we're talking about. This standard is trying to answer one simple question. When you have credits, because you've spent money exploring, so credits to cash, to wages payable, to accumulated depreciation, maybe to other stuff you use up, the question this standard is answering is, where does the debit go? And how do you treat that debit? And that's basically what this standard is directed at. Okay, so it's not an industry standard. Other standards cover some of those other parts, and we're only focusing on the exploration and evaluation part. Okay, so let me tell you essentially what the standard says. Now, notice I've got the concept of area of interest up there in italics. And I'm going to talk about that again in a few moments, because that is actually quite important. But when you think about the sort of things we do for exploration, there's a whole bunch of things that we do. I mean, we might purchase a database, right, as that tells us where other people have explored in the past. Now, that's useful information because, you know, there might have been another company that explored for copper in this area. And if you know, copper and gold generally go together, and tin and silver generally go together. So if a company has explored in this area for copper and we're looking for gold, knowing where they've explored for copper and haven't found anything is useful information for us. So purchasing a database, it's an intangible, but, you know, that's a part of the cost of exploration and evaluation. Doing hydrographic surveys, so looking at how the water flows and how that relates to resources. Doing topographic surveys, doing core samples. So you've probably seen in movies where they drill those holes. I don't mean the ones for oil, but you drill all these holes and you pull out a solid core of soil at different levels. You say, all right, 50 meters down, there's 5 parts per million of gold. 70 meters down, there's 20 parts per million of gold. So you're trying to assess how much resource is there. Interestingly, a friend of mine, when many years ago, when she started dating her husband, when I first met them at some party, you know, you chit chat, and I asked him what he does. And this guy's job was, would you believe it, measuring gravity. And I thought, what the hell? I mean, surely gravity is 9.8 meters per second squared that way, going down, right? But it's not. It's not always 9.8 meters per second squared. And it's not always straight down. It's sometimes off to the side. And measuring gravity getting a sensitive measure of gravity tells you something about the underlying density of what's underground. So it helps you assess what resources are there, right? So all of those things are exploration and evaluation expenditures, as well as doing the calculations, the technical feasibility study, the bankable feasibility study. All right, so that's the money you've spent. Where's the debit go? You've got a choice, 2 options. One option, everything goes to expense. Easy. And we're going to see in our practical demo later, one of the 2 sides of the paper is going to have that. Everything's expensed. The alternative is partly or fully capitalized. So remember what capitalizing means. Capitalizing means recording something on the balance sheet. So when you capitalize a credit, you're recording as a liability. When you're capitalizing a debit, you're recording it as an asset. Okay. So partly or fully capitalized, so long as it meets the requirements in paragraph whatever. That's the paragraph, I think. So let's have a look at the conditions. So this is basically saying, when are you allowed to record the debit as an asset? Okay, I'm trying to draw on here is probably going to be uncomfortable, but so when can you record the debit as an asset? Okay, a number of things need to be true. The first thing that needs to be true is the rights to tenure of the area are current. So generally, you can explore anywhere you like if you can get away with it. But you can only extract resources if you've got the right to do so. In countries like Australia, that means the government gives you a mining lease or an exploration lease. And it can be under land that somebody else owns. So in a country like Australia, if I own the land, I only own, the top of the land. I don't own it all the way to the center of the earth. So the right to extract those resources is something that the government disposes of. In the US, my understanding is that if you own land, you own it all the way down to the middle of the earth. So in that case, getting a right to tenure involves leasing it from the landholder or purchasing the land, perhaps. Anyhow, So it's clear that if you don't have rights to the area, then you can't have an asset. Because if I explore in your backyard, I don't have the right to extract those resources. So there's no way it can be an asset because I don't have the right to access it. Apologies, coffee. Okay, so if that is true, then when can I record it as an asset? Two things, two options. One, I expect to recoup that expenditure. In other words, I expect to get future economic benefits. This is the normal asset, right? This is the one that you and I would say, are there future economic benefits? And the answer is yes. Then clearly it's an asset. The debit goes to asset, no problem. The second one is the bullshit one, right? It's the one where you're still exploring, but you're not sure whether you've found anything. So this is how this standard varies from normal accounting standards. Normal accounting standards basically say, have you got some future economic benefits? And if the answer is yes, if the answer is yes, it's an asset. If the answer is no, it's an expense. That's what a normal standard would say. Are there future economic benefits? This standard gives you a third option. And the third option is no, but I'm still looking. And if the answer is no, but I'm still looking, then you can record it as an asset, right? That's where this standard is political. It allows you to record it as an asset, even though you're not sure you found anything yet. Okay, now, what does it mean I'm still looking? I'm still looking means you are still evaluating and exploring that area of interest. So you make this decision, you carry forward for each area of interest. Okay, so clearly, therefore, what the definition of an area of interest is going to matter in determining this. So let's move forward. What is an area of interest? An area of interest is defined geologically, right? And if you've got an accounting firm that does audits of mining companies, they will either have geologists on staff or they will have contracting geologists to help assess this. This is not some bullshit accounting judgment call, right? This is a geologist's objective call. So are the circumstances for finding your resource, whatever you're looking for, gold or tin or silver or magnesium, are the conditions to find that resource consistent across the area of interest? So in other words, we're trying to answer the question, are all parts of this area of interest geologically similar, right? And you'd like to think that that is a lot more objective than any judgment an accountant would come up with. Now, if any of you know anything about geology, I think there's probably some subjectivity there as well, because what does similar mean? I don't know. Okay, now I want to give you an example. Before I look at how we deal with the debits and credits and the account names involved, I want to tell you why area of interest, the definition of area of interest matters and why we need it to be objective. Because if we had flexibility with defining the area of interest, then we would actually have flexibility with how much goes to expense and asset. And we don't want that. So I'm just going to change this to make these things 3 colors. Ignore the writing for the moment. Okay. Now, I'm going to say, what if, now this is not true. There's no way this can be true. Australia is an entire continent. So there's no way that, this bit up here is geologically similar to this bit down here. There's no way that's true. But let's assume, for argument's sake, that the area of interest is the entire country, right? If the area of interest is the entire country, then so long as you're still exploring in the area of interest, you don't have to put any of the debit to expense. So long as you are still exploring in South Australia, if the area of interest is the whole country, don't forget Tasmania, then the fact that you haven't found anything in Queensland is irrelevant. You are still exploring in the area. So even though the Queensland mine shaft or Queensland core samples might have come up negative, Because you're still exploring, you don't have to record anything as expense yet. It can stay on the balance sheet. Okay, so if the entire country was the area of interest, then it's really easy to keep a lot of stuff in the asset account. Now let's step back for a second and say, well, hang on, what if the entire country is not the area of interest? What if a state is an area of interest, right? Oh, I hate how you, PowerPoint hates how I, so what if Queensland is one area of interest, South Australia is another area of interest, and WA is another area of interest? Well, in that case, look at what's happened in Queensland. You haven't found anything and you've given up. And if you've given up, you're no longer still looking, so you can no longer keep that as an asset. So as soon as you give up in an area of interest, you will have to write this off, okay? Because Queensland here is a separate area of interest from South Australia, right? So if you give up in an area of interest, you've got to write it off. Now, it turns out, given how big Australia is, areas of interest are going to be a lot smaller than this. You know, up here in the Northern Territory, that if you have a mining lease there and you have a mining lease here, now, I don't know, I'm not a geologist, but it's likely that those two mining leases are going to be different areas of interest because they are probably geologically different. I'm not going to go off to Google to find a geological map. You can work that out yourself. So area of interest is a geological concept. It is not a legal concept. It's not about how big your mining lease is. Although in many cases, I guess most mining leases will be separate areas of interest. But you can imagine situations where they're not, right? You could imagine one mining lease from the New South Wales government up here and another mining lease from the South Australian government over here, and they're right next to each other. Or they might even be a few kilometres apart, it doesn't matter. So they are going to be separate mining tenements, separate mining leases legally. But in terms of area of interest, it's not the legal definition, it's the geologic definition that matters. So, and again, I don't know enough about geology to say whether this is true, but it's probably likely that both of these mining leases will be the same area of interest. Okay, it's up to you to have a look at a geological map of Australia to work that out, but that might not necessarily tell you that. Okay, so why does the definition of an area of interest matter? The smaller the area of interest, the more likely you are to write off the asset early. Right, go back to the Queensland example. If the whole country was an area of interest and you gave up in Queensland, because you're still looking in the area of interest, South Australia, you don't have to write anything off. But if each state was an area of interest, then as soon as you give up in Queensland, you have to write the debit asset off for the Queensland part, right? So that's why size of an area of interest matters. And realistically, an area of interest is going to be a lot smaller than a state. I mean, I'm Tasmanian, and I can tell you that the geology of the West Coast, where there are silver mines, or there have been silver and tin mines, are certainly a lot different than the geology of the East Coast. Okay, they're just simply different. So for a state as small as Tasmania, you know, you're just moving, what, 200 kilometres, and already it's quite different. So an area of interest is going to be a lot smaller than a state. Okay, so that's why the definition of area of interest matters. Let me just get rid of this drawing. So let me now talk about how you do the accounting. All right, so remember you've got the choice. One of your choices is just expense all your exploration and valuation costs. And if that's the choice you take, that's fine. Then you don't have to worry about, you know, this area of interest stuff. However, if the choice is we're going to carry forward costs, then assume that you're exploring in 3 areas of interest, right? You've got one up there in Queensland that's close to Mount Isa, one in South Australia that's close to, I don't know the geography of South Australia. And you've got one up there in the Pilbara or the Kimberley of WA, Western Australia. You're exploring in 3 areas, and at the end of the year, you find, we found something in WA. We haven't found anything in South Australia, but we're still looking. And we haven't found anything in Queensland, but we've given up. So what do? Remember that when you carry forward, or maybe I haven't said this, so I probably need to say it now. When you carry forward these exploration costs, you have to call it exploration and evaluation asset, right? There are not many places in the accounting standards where you have to use particular account names, but you've got to call it something like exploration and evaluation asset or something similar. You might be able to get away with calling it deferred exploration and evaluation costs, so long as it's still on the balance sheet, right? So you've got to call it that. If you are still exploring, you can keep adding more debits to it. However, when you give up, like Queensland here, when you give up, as soon as you've given up, you can no longer have that asset there. That asset has got to go to expense, okay? Also, what if you find something? If you find something, you can no longer call it exploration and evaluation asset. You have to reclassify it. Instead, you move the asset, you move the debit to some other asset. We're going to call it asset under construction, which is a dumb name, but let's stick with it for now. So what's this basically giving you? It's telling you that if you've spent money looking for stuff and you haven't found anything yet, you call it EEA, exploration and evaluation asset. So you know that EEA is where you put, it's a bullshit asset. However, if you find something, you have to move the debit out of EEA. And what that means is it guarantees that EEA is a bullshit asset. Because if you've actually found something, it's a real asset. So you can no longer call it EEA. So what this basically means to you and me, if we were to look at the balance sheet of a mining exploration company today, and we saw exploration and evaluation asset listed among the assets, we would all know that that is a bullshit asset, right? It's money that you've spent looking for stuff, but you haven't found anything yet. That's my definition of bullshit, right? So what we've really got is a standard that politically, given what happened in the 1970s, required American standard setters, and everybody else went the same way, required standard setters to allow companies to record this thing as an asset. So they lost that fight, the fight of saying, hey, it should be expensed. Instead, they had to agree with, the outcome of the political process, which was to say, well, we've got to allow companies to record it as an asset, but we're going to get our revenge, or we're going to make sure the information is useful. Okay, we've got to let them record it as an asset. That's cool. But we're going to make sure that asset has a specific name. It's called exploration and evaluation asset. So anybody who's done week 5 of ASR will know that if they look at a balance sheet and they see exploration and evaluation asset, they're going to know it's a bullshit asset. And it doesn't matter, what stories managers tell you. Managers telling you it's a real asset are sort of like gamblers who tell you that every lottery ticket they buy is an investment. Yeah, this one lost, but eventually if I keep buying, I'm going to keep winning. Realistically, that's not an asset. Okay, so that's basically the big picture of what AASB 6 does. Now, let's just zoom in on a few little details before we go on to an example. So a few key points. Now, this is where it gets a little bit funny. We know that this standard is the outcome of a political process. So we know it's answering the question, where do the debits go? But if you read the rest of the standard, it's pretending to be a real standard. It's pretending to say something like, oh, look, hey, we've got these assets. Gee, how do we measure them? Do we measure them at cost? Do we measure them at... And the answer is we measure them at cost. I mean, but that's pretending to be a good standard, because this is like saying we're talking about the cart rather than the horse. But it's the horse that matters here. We're required to allow people to put these costs on the balance sheet. So here it is trying to be a real standard. Now, this second part is not so dumb. Okay, EEA, okay, we know it's bullshit, but you can still classify it as tangible versus intangible. So I'm just going to turn off my aircon. It's a bit warm in here. I thought it was going to be cold. Okay. So think of the things that I mentioned earlier you could do in exploring and evaluating. You could buy a database, right? And some companies do that. They'll buy it or they'll purchase access to a database. You could call that an asset, and that is clearly intangible because you're buying knowledge. You're buying the right to use data. So we can clearly say that that's, hey, if we're allowed to record it as an asset, we may as well call it intangible because we're not getting anything physical for it. However, we could have tangible exploration and evaluation assets. Even though we sort of agree it's bullshit because it's not going to have future benefits, it can still be tangible. And you might think, well, how the hell does that work? If it's tangible, surely you're going to get some future economic benefits. Well, think about it this way. Let's assume that you're a company exploring in a very remote part of Australia. And in that remote part of Australia, you actually have to go in and physically take some core samples. And you've got to do some on the spot, on location analysis. So you might build an access road. You might construct a temporary building for the geologists or the hydrographers or whoever who goes out there to do that work. Clearly, those are tangible elements. Now, are they still bullshit assets? Yes, because if you haven't found anything, even though it's physical, you can't sell that access road to somebody, right? It's in the middle of nowhere. Who wants to go see a hole in the ground? Oh, maybe the mafia, but probably nobody else. Realistically, you can't, you put a little shed there for the scientists to live in while they're checking stuff out. Again, you probably can't sell it to anyone. So it's still a bullshit asset, but it is tangible. Okay, so we can still make that distinction between tangible and intangible. Okay, the last point, and this is the point I made when I had that map up there. An EEA shall not be classified as an EEA once you've determined that technical and commercial viability exists in relation to a mineral resource. In other words, you can extract it, that's the technical viability, and it's commercially viable. So, you're looking at the market price, you're looking at the cost of the extraction, it's commercially viable to extract that resource. So that's true. In other words, going back to that map, you're in Western Australia, you no longer call it EEA, and you have to move the debit somewhere else. And the debit, we're going to call it asset under construction. I hate that name. If it was up to me, I'd call it cost of stuff in ground or cost of resources found or something like that. So why am I calling it an asset under construction? Because most accounting textbooks call it that. And I think the logic there is it's sort of asset under construction because you've sort of invested in finding this stuff. And the next thing you do after you've found it is you start actually constructing infrastructure and stuff. So it's sort of like work in process PPE. It's a weird name. But, you're going to see it often enough, so you need to be aware of that. Okay. Now, we're pretending this is a real standard. So we're saying, oh, how do we measure it? What about impairment testing? Blah, blah, blah. Well, impairment testing is actually pretty straightforward here. Impairment testing basically happens when you give up on an area that you're exploring. So go back to that map, look at Queensland. We were exploring in Queensland, eventually we gave up. So where's the debit go? Going to move it out of the asset, EEA, credit EEA, and debit, loss on impairment of exploration asset, something, whatever you want to call it. You don't have to have a special name, but it's going to be on the income statement. Okay. So just to summarize what our options are and how those options work. First up, if you spend money exploring, the question is, where do the debits go? Option one, expense everything. So that's it, you're done. Option two, you record it as an exploration and evaluation asset up until the time that you can make some decision. So if the decision is we found something, then we no longer call it EEA, exploration and evaluation asset. It moves to something else, asset under construction. And eventually, as we pull it out of the ground, it stops being asset under construction or whatever asset we've recorded it at, and it becomes inventory. the next thing you do is develop the site. So you add more cost to the site, and then you pull it out of the ground. So some of those debits, both from the cost of finding and the cost of developing, move out of those assets, they move to inventory. And then they move from inventory to cost of goods sold. So that's if you found something. If you haven't found anything, if you're still looking, then it stays in EEA, and you just keep asking the question again every year. Alternatively, if you give up, then you just write off the exploration and evaluation asset. So, I think that's pretty straightforward. Now, it's important to understand that this standard is about recording the cost of finding the resource. And remember one of the things I said earlier at the beginning, a thing about the mining exploration industry is what you get out is not necessarily related to what you put in. You might put a little bit of money exploring and suddenly you find a lot of gold. These days, probably unlikely. I reckon most of the gold has been found. But the relationship is actually quite weak. So we're answering the question, how do we treat the debits of exploration? That is the cost of finding them. That is not the value of the resources. And in fact, it's not really possible to record the value of the resources because it's really hard to estimate. So many mining companies will actually give you, in the disclosures, in the notes, they'll give you information about probable reserves, proven reserves, if you like, their different levels of certainty. Different levels of certainty relating to what you found. But even then, it's really hard to know what you've got. Because imagine that you're looking for, even something as simple as oil, right? It's a liquid. It's either there or it's not. But let's say that you drill a well and you find there's some oil coming up. How do you know how much? Well, how do you know the size of the cavity that contains the oil underground? How do you know the shape? By doing more wells in different spots, you can sort of work out maybe what the shape is, but it's really hard to know that for certain. With granular resources like gold or silver or tin, you don't really know, right? You might drill a core sample and you say, okay, 50 meters down, it's 20 parts per million. But 100 meters that way, 50 meters down, it's 10 parts per million. So not only do you not know whether the density is consistent, but you don't know the shape of the ore body. So estimating the resources is basically, you can do it sort of sensibly, but it's still, there's a lot of noise, a lot of uncertainty in those measures. And I remember soon after I moved to New South Wales, moved to Sydney when I was in my 20s, I used to wake up with the alarm clock turning on the news. In those days, that's how it worked. I remember one morning I woke up and there was a story that Shell, Shell Petroleum, or Royal Dutch Shell as it used to be called, I think. Shell Petroleum had reassessed the value of all resources it had access to. So it had been disclosing how much oil it thinks it has access to in all these different places on the planet. And their reassessment, they looked at this again geologically, and they assessed their amount of oil they had access to down by, this is almost 30 years ago, so I can't remember, down by 30 or 40%. So there was a serious reestimation of how much resources they had access to. Okay, so we're not trying to measure that, because trying to measure that would be a fool's game. Okay, so let's look at lecture demo 1, and I'll just kill the slides from this and I'll bring across the lecture demo. So let me just rearrange a few things on my desk just so that I don't have anything in the way. Okay. Actually, apologies. I'm just going to split the window so I can use that a little bit more. Okay. So here's the setup. We're keeping it pretty simple. We're assuming 2 areas of interest. So there's one area of interest that's located in Western Australia. Okay, so it's a small site somewhere in Western Australia. There's another area of interest that's located in Queensland. And this is before Bobcatter became politically, we don't change the examples. Why should we? They're still relevant. So basically, Catter Mining has spent money in each of these 2 areas. Mind you, none of the numbers are realistic, right? They're really small, but it's just to illustrate. So at the end of 2012, Canna Mining has determined there's gold in economically recoverable amounts at the Western Australian site, but there's no gold in Queensland. So they've realised, hey, WA is cool, and we're going to work with WA. Queensland, there's nothing there, so we give up on Queensland. And then once we do that, we put some infrastructure in place, right? So we put a building and some access roads. And then we start production and we extract some gold and then we sell it. Now, I just want to draw your attention to two things before we actually move on to the journal entries. The first thing I want to draw your attention to is the buildings are portable. Okay, sorry, let's just go. The buildings are portable. And the other thing I want to draw your attention to is the other infrastructure seems to be of the nature of roads and stuff. And let me tell you why I've highlighted those two things. So far, whenever we've been doing depreciation, I've always said the debit is usually depreciation expense unless it's helping you make another asset. Well, in this case, the debit is helping you make another asset. It's helping you make inventory. So the depreciation that you do on these two assets is going to affect how you measure inventory. Secondly, whenever we've done depreciation before, we've always done straight line using a calendar measure of life. So we've assumed that the useful life of the asset is measurable in calendar time. That is appropriate for the buildings, right? The buildings are portable and they have a life of 8 years. So the fact that the buildings are portable means it doesn't matter how long they're used in this site. If this site finishes with them at the end of the year, then we can still move them to another place. So whether they're used here or not, their useful life is 8 years. So measuring their useful life in calendar time makes sense. However, for the roads and other infrastructure, there's an issue. Because for the roads and other infrastructure, think of a road, you can't move it elsewhere. And if this is in some remote location, then you probably can't sell it either. So the roads and other infrastructure only have benefits as long as they're helping you extract gold. Once all the gold has gone, all the benefits of those roads and that infrastructure disappears. So it's not appropriate to depreciate those roads and other infrastructure using calendar time, right? Roads are clearly an asset. Like if you put a car park on some land, money you've invested is going to give you future benefits, clearly an asset. But its life is measured in proportion to the gold that's extracted. Once all the 250 kilograms of gold that you found are gone, those roads will have no future economic benefit. So we are not going to depreciate them using calendar time, right? We are going to depreciate them using units of production. So can I stick no, I'm not going to stick a note in it. Let's move on. Okay. Can I just tighten this up a bit? So I'm just going to tighten that up so we can see a little bit more on one page. Okay. Now, remember we have two choices. One choice is we can expense everything. So if we're expensing everything, we just take how much we've spent each year. Let me just move the split up a bit so we've got the numbers here. So we take how much we've expensed each year. And we don't need to keep them separate for each area because we're expensing the lot, right? So we're not going to carry forward some, not carry forward others. We don't care. So just expense everything. So that's the expensed costs method. Everything gets expensed. If it's the carry forward option, then you need to keep the two areas separate because one might end up getting written off and another one might end up getting carried forward. So you're going to keep the WA EA separate from the Queensland EA. And then you get to 2012, you spend some money and you realize, look, the Queensland EA is going to be written off because we haven't found anything there. So for the Queensland EA, we're going to, oh, I don't know, choose a color. We're going to basically take that out and put it into impairment loss. Okay, so the Queensland EA has gone. Let me choose grey. Okay. However, WA, we found something. So WA costs, we got 4,500, we got 7,000, we've got 6,500. So altogether, that's 18,000. So if we found something, we no longer can call it EEA, right? Because EEA is meant to be a bullshit asset where you're not sure whether you found anything. So if you found something, you can no longer call it EEA. You call it something else. And I've already mentioned that we're going to give it this weird name, assets under construction. Okay, so let me just make that bold. So I'm just going to put an extra line in here just to summarize. So from page 1, we've expensed everything, but we're carrying forward 18,000 in the carry forward method. Over here in the written off method, there's nothing being carried forward. Okay. Now that's important because it's going to come across onto the next page. So let's go on to the next page. On the next page, we start doing some development work. So these assets under construction, we could leave them in assets under construction so long as we remember that we're going to depreciate them in proportion to the gold that's extracted. So if half the gold is extracted, then half of that debit should go across to inventory. If 3/4 of the gold is extracted, then 3/4 of that 18,000 will go to inventory. But that pattern of consumption is also what we're going to be doing with the infrastructure. So it actually makes sense to put the infrastructure and the asset under construction, the cost of finding the stuff, it actually makes sense to put them together because they're going to be treated the same way. They're going to be depreciated. Oh, sorry. I'm using my Excel shortcuts instead of my Word shortcuts. They're going to be depreciated based on how much gold is extracted. So that's what we've got there. In the written off method, all we've got is the 12,000 because there was no 18,000 carried. There was no 18,000 carried forward, right? In the written off method, the 18,000's already been expensed. In the carry forward way, Queensland's been expensed, but the 18,000 WA is still being carried forward. Okay, so we record the infrastructure that we've put in, we add the carried forward exploration costs, and we put them both into PPE because they're both going to be depreciated the same way. They're going to both be depreciated using units of use based on the amount of gold. Now, the building, building is really a type of PPE, right? Property, plant, and equipment can be land, it can be buildings, it can be other stuff. So, if you wanted to, you could call this PPE other, call this PPE other, and you could call this PPE buildings. It doesn't matter. But, for the moment, let's just be sloppy and straightforward. So why are we recording the buildings separately? Because they're not going to be depreciated the same way as the rest of the PPE. The rest of the PPE will be depreciated in proportion to the gold. But the buildings are portable. Even once all the gold's gone, the buildings will still have some value. So the buildings are going to be depreciated using calendar time. So that's why we're recording them separately. The PPE has got stuff that's going to be depreciated using gold. The buildings have got stuff that's going to be depreciated using a calendar. Okay. So let's now extract the gold. In this first year, I think if I remember from the question, we extract 40 kilos of gold and it costs us $3.50 in cash costs. They're going to be wages and other stuff, but let's assume the cash cost, $3.50 a kilo to extract it. Okay. So let's do the extraction. And this is probably where people get a little bit freaked out. So I'll do this a little bit more slowly. What is the cost of the inventory going to be? the cost of the inventory is going to be made up of the different components that you've spent. So I think hopefully it's reasonably clear that if you're extracting 40 kilos at $3.50, then you're spending $140 on extracting the gold. Sorry, the format annoys me a little bit there. Okay. Secondly, what's the other cost of inventory? Well, part of what goes into extracting that gold is having that building depreciate. And remember, the building is depreciating over calendar time. So the building costs you $1,600. It's going to last 8 years. So 1 year's worth of depreciation is $200. Okay, so we've got that. Now, thirdly, the PPE. So in the carry forward method, the PPE contains 30,000, right? It's the cost of finding it plus the cost of infrastructure. In the written off method, it's just the cost of infrastructure because the cost of finding has already been written off on the previous page and nothing was being carried forward. Okay. So how do we calculate this 4,800? That 4,800 is the 30,000. Oh, damn, I can't remember how to do a times sign, so I'm just going to use an X. Is it Alt 0247? No, it's a divide. Alt 024. No. Yeah, sorry, I can't remember how to do a times sign. Anyway, times and X look pretty similar. So let's make an X. It's 30,000, actually. Oh. Divided by 250, right? So that's how much per kilo. How many kilos did you extract this year? 40. So 30,000 divided by 250 times 40 gives you 4,800. That's what we've done here. Over here on the right, we're doing a similar calculation, but it's not 30,000. It's 12,000. Let's just make that a little bit wider just so we can fit that in. Okay, so that's where the 4,800, sorry, not 4,800, that becomes 1920. Okay, so that is where you get, let me just make them consistent color-wise. So that is where you get 4,800 and the 1920 from. So that's your cost of inventory. Or that's part of cost of inventory. So where does the 5,140 come from? It's the sum of all the different costs that you spent or incurred in order to create that inventory by pulling it out of the ground. Where's the 2,260 come from? It's the sum of those costs. Okay. And then you sell it. This part's a no-brainer because you extracted 40 kilos, but I think you sold 30 and you sold them at $150 each. Yep. So the sales revenue is straightforward. The cost of goods sold, what's this? Well, if this is 40 kilos, then 30 kilos is going to be 3/4 of that, right? And they do the calculation down here. Over here, if this is 40 kilos, then 30 kilos is going to be 3/4 of that. Okay. So hopefully that's brought it all together, and that is basically mining, or rather mining exploration, I should say. All right, so let's jump out of there and go, oh, EndNote. I don't want EndNote. Go away. Go away, EndNote. Okay, cool. So we've done rocks. Now let's do sheep. Agriculture. Now this is where I wish I could draw. Because I can't draw on this screen, I will probably play a little with Excel. So let me open up Excel and I'll try to do some pretty stuff in Excel there. Okay. So I'll use this as I'll use that and I'll see how well I go with that. Okay. So agriculture. We're talking about, this used to be called, the old standard used to be called self-generating and regenerating assets. Basically plants and animals, right? But this is essentially about agriculture. This is not about trees in a national park. This is not about cockroaches used for racing. right? This is about animals animals and plants used in order to generate agricultural produce. So to generate milk, wood, meat, fruit, wool, that sort of stuff. So again, I don't need to justify why this is important. I guess probably the one point that I do need to make about agriculture and why we've got the standard that we do have, because it keeps talking about fair value a lot, is because as a general rule, agricultural commodity markets tend to trade pretty continuously. So when I lived in Hobart, when I was young and I was still at uni, there was a stockyard north of the city where every week or two there would be a cattle sale. And it was normal. You would have sales of animals on a regular basis. Actually, up the road in my suburb, this is now a series of apartments, but there was a wool grading warehouse where they bought in wool from the farmers that had been sheared, and not the farmers were sheared, you know what I mean. And they were basically grading the wool and selling it. So these commodities, you can generally get prices for them fairly continuously, which means that a fair value from a market is pretty accessible. So that's the logic why this standard talks about fair value, because generally the fair value is pretty accessible for agricultural commodities. They tend to trade fairly continuously. So in fact, let me tell you the overall bigger picture. This is what I'm going to do stuff in Excel, and then I'll come back to the slides. So we're really talking about two sorts of things in this standard. We're talking about biological assets and agricultural produce. So for biological assets, we've got an opening balance, and at the end of the period, we've got a closing balance. And presumably, therefore, we have a change. So the rules for what you do here are actually very straightforward. How do you measure the opening balance? The opening balance is going to be fair value less cost to sell. How do you measure the closing balance? Fair value less cost to sell. What about the change? The change is going to be gain or a loss. That change, get an arrow, and let's get a pie for profit. Oh, I can't see a pie. Let's just say, whoa, freaky. Hang on. Oh, sorry, 11. Excel does this for a strange reason. The change will be a gain or a loss, and it will go to the income statement. And that is the straightforward rule. Now, in terms of measurement, that's as hard as it gets. In terms of disclosure, because there's a lot of disclosure information the standard requires, you've actually got to talk a little bit about some of these changes. Like how much of that change was from natural increase, in other words, new sheep being born, new trees being seeded, how much of the change is due to possibly animals dying, how much from stuff being taken away, how much from purchases. So you need to break down how the change occurs. Often you're going to find a reconciliation of these things. And one thing you do need to give people information about in the notes at the end is you actually need to break down some of this biological asset information, not in the measurement on the income statement and balance sheet, but in the notes, into two components. So you need to tell people about your bearer assets, and your consumable assets. So you sort of need to break them down into categories. And the difference between bearer and consumable is actually pretty straightforward. A bearer asset is an asset that keeps existing when it gives you agricultural produce. So at some point in time, let's not do it there, let's do it here. At some point in time, agricultural produce will be derived from the biological assets. So the question is, how do you derive it? Is it because it is a cherry tree from which you pick fruit? In that case, the cherry tree keeps existing after you've picked the fruit, and so it's a bearer asset. Alternatively, is it a cherry tree that you chop down in order to use the wood? because cherry wood is actually quite nice. In that case, it's a consumable asset. When you chop down the tree is consumed in generating the agricultural produce. Now, none of the rules here for the biological asset really change. You still have got a bunch of trees, which you still value at fair value less cost to sell, right? The fact that they may not be the same trees that you had at the beginning is not really an issue. And this applies to herds of animals as well, right? You might have sheep that you have for wool, or if you make sheep's cheese for milk. You might have sheep that you kill for meat, consumable. Okay, so in either case, you're still going to have a herd of sheep at the beginning and a herd of sheep at the end. They might not be the same sheep, but the herd will still exist. So how you measure is not really complex. Now, agricultural produce. Same general approach. Gains go to the income statement and it's measured at fair value less cost to sell. But whereas for biological assets, measurement is an opening balance, closing balance change thing, you're looking at it over a period. With agricultural produce, you only look at it in a moment. So when do you need to measure agricultural produce? You measure it looks like accounts payable. When do you measure agricultural produce? When it is separated from the biological asset. So when you shear the wool, when you remove the cherry from the tree, when you kill the sheep for meat, that is when you have to measure the agricultural produce. And the answer to how you measure it is, surprise, fair value less cost to sell. And when you measure it, it's as if the produce appeared out of nowhere. So you don't credit the biological asset. You actually record the debit for the agricultural produce and the credit goes to a gain as if the asset had appeared out of nowhere. Okay, so again, the gain loss, well, it's not going to be a loss. The gain goes to the income statement. However, this is only something that relates to a moment. That is answering the question, how do you measure agricultural produce when it's removed from the biological asset? Because once you've measured it, it no longer comes under the agricultural produce rule. It then comes under the inventory rule. And you then look at AASB 102. It's 102, isn't it? It's checking. Yep. Okay, so how you measure it, that becomes part of your cost records. So agricultural produce is only a question you need to answer in a moment. Now, before I move on to the example, or to some more slides and then the example, I want to just make one point to you, and this is don't overthink this. Pretend the agricultural produce comes from nowhere, right? I've had people in the past ask me, well, hang on, if you're separating the agricultural produce from the biological asset, surely you should debit the produce and credit the asset. But that only makes sense if you have previously debited the asset to record any growth, any additional sheep, any sheep getting bigger, any wool growing, and you haven't done that. Look, the best analogy is wages, right? Why is it okay to put, when you make a wages payment, why is it okay to put it to wages expense? Because really, when you're paying wages, you're not paying an expense, you're paying a liability that built up over the last 2 weeks, right? But if you did that, you get totally stuck in doing journal entries. You'd be recording debit wages expense, credit wages payable for every second a person worked. And then when you pay them, you'd go debit wages payable, credit cash. So if you want to take it away from something, you first have to create that thing. With wages, we don't do that. We don't record wages liability for every second somebody works. This is exactly the same point. We don't record the growth every moment the biological asset grows. We only record the growth when we pick it up, when we harvest it, when the produce is removed from the asset. So if you wanted to think that, you could probably play with some numbers. In fact, I did this a few years ago. I played with the numbers and I found, you know what? If I record the growth and then I treat the removal from the asset as a credit, it actually gives you the same profit and the same assets. It makes no difference. So my point here is don't overthink it. When you harvest the agricultural produce, think of it as just coming out of nowhere. So let's go back to the slides and then we'll go to the prac demo. So we know what agriculture is. We're excluding things like national parks. We're excluding things like horse racing. We know what a biological asset agricultural produce are. How do we measure them? Look, recognition, not a problem. Biological asset, I told you this. It's measured at fair value less cost to sell. At the beginning, when you first recognize it, and at the end of the period. Now, implicitly, if a sheep is born during the year, then effectively, by picking it up at the end of the year, you're picking it up at fair value, right? And there are some disclosure rules that are additional, but you don't need to worry about picking it up when it first appears. I remember when I started working for an accounting firm many years ago, worked in Tassie, so I had a lot of farmers. For the tax rules had these weird rules. Like I think every time a cow was born, you recognized it at $2. Every time a sheep was born, I think it was $1. It was just this notional way of measuring income that the tax office had. Don't worry about any of that. Okay, I made the point about agricultural produce. With agricultural produce, we're talking about accounting just at a point in time. Okay, and then after that point in time, it becomes inventory and it follows the inventory rules. Okay, so I think I've covered all of this stuff. What's that little, don't know what that mask is there for, but I don't care. Okay, so we've covered all of this. The only other point that I need to make is sometimes it's hard to measure fair value less cost to sell. And so, look, this is rare, but sometimes you might buy some small trees, some saplings, which are not really saleable. And so in certain circumstances, cost might be an appropriate measure. But the other time where you might have a problem is, what if you've got some trees on some land and it's hard to measure the value of the trees? Well, you could probably measure the value of the trees plus the land. And if you look at neighboring land, you could probably measure the value of the land by itself. So you could work out the value of the trees. Look, that sort of thinking is great for Europeans who write these sort of standards because, your farm is here, the next farm is 500 meters down the road. So the land prices are likely to be the same. In Australia, where some farms are bigger than a small country, the next farm may be 1,000 kilometers down the road. So the price of that farm doesn't tell you much about the price of yours. So there's a bit of theory there, and some of it I'm not sure how applicable that is. Okay, so let's have a look at the lecture demo for this one. Just close that. Bring across the lecture demo file. There we are, okay. All right, so let me tell you the story first up. By the way, there's some stuff here that's green. It's green on my screen anyway. Just ignore this for the moment. I'll come back to that at the very end. Okay, so here's the story. Weak Arrow grows apples which are sold to local cider producers. On 1st of July 2018, Weak Arrow's apple trees had a fair value of $750. At the end, during the year, they spent $24,000 on fertilizers. Apples were harvested, blah, blah, blah. At the end of the year, the trees had a fair value of $770. Okay, so let's do the easy one first. Let's look at the change in value of biological assets. Now, in order to do that, first up, let's look at fertilizers. Think of the fertilizers just like repairs and maintenance. They're a straight expense, right? So now let's look at the trees. Beginning value 750, ending value 770. So you've got a gain, where are we? On the apple trees here of 20. Actually, what I'll do is I will highlight them so I know we've done them. Now, I think a point I made earlier, I hope I made this point. Accounting standards tell you what has to end up on your income statement and your balance sheet. It doesn't tell you how you get there. You can get there different ways. So this standard tells you that the gain in the value of the apple trees has to end up on the income statement. The fertilizer expense has to end up on the income statement. There are different ways you can get there. Look at the effect so far in yellow. There's a loss, there's an expense of 24, there's a gain of 20. So overall effect there is -4. Now you could say that, hang on, if I fertilize the trees, I'm increasing their value. So you could say that instead of debiting fertilizer expense 24, I would debit the trees 24. You could do that, right? But what that you'd then be doing is you wouldn't be recording a fertilizer expense. You'd be bringing the trees from, was it 750 to 770? So the trees would be, you'd be bringing the trees from 750 to 774. And then you look at the closing value of the trees and it's 770. So here you'd be recording, instead of a gain of 20, a loss of 4. So you'd still end up with the same effect on the income statement. It's either going to be a -24 and a +20, or if you want to do it a different way and want to add the fertilizer to the trees, you'll still end up with -4, which is the overall effect. Okay. So that's the fertilizer and the trees. There's one point I need to make, and please don't go away until I make this point. And the point that I want to make, and I'll make it once I've done the journal entries, is that, choose a color, those two 8,500s are not the same number. They are different things. They just happen to be the same, but they're not. So I'll come back to that in a moment. Okay, so inventory. When we're harvesting agricultural produce, if this wasn't the inventory, if this wasn't the agriculture standard, and this was a simple standard normal cost model, then you wouldn't be recording the inventory at 146,500. You'd be recording the inventory at whatever it cost you to get it. So if this was a normal cost model, you would have debit inventory, 21,000, credit cash, 21,000. If this was normal, no special standard. But the standard explicitly says that when you record the inventory, you have to record it at fair value less cost to sell. And you've spent the cash, 21. So that means you've got to pick up a difference of 125,500. Now, where does the 146,500 come from? That 146,500, you are told that the apples were a market value of 155, were harvested at a cost of 21. We've got the 21. Sales commissions would be paid on the sale of the apples. That word there, would, is very important. This is not an amount you have spent. This is your estimate of how much you would spend. So remember what you're doing during the year ended 30th of June. You're estimating the fair value less cost to sell. The two components of the fair value less cost to sell are the 8,500 cost and the 155,000 value. So your estimated fair value less cost to sell is 155,000 minus 8,500. In other words, it's 146,500. That's where the 146,500 comes from. That is your estimate of how much you would pay in commission. The word would here is, I think, key. Now, when you actually do come to sell the apples, what happens? Well, the inventory, 146,500, goes out to cost of goods sold. You get sales revenue of 155. Your selling expense actually ends up being 8,500. This now is the actual cost. 8,500. So your estimate happened to be right. So how much profit do you have from selling? None. Because you've got revenue 155, but you've got expenses of 155. So there's no profit if the price has not changed. So what you're really doing in this standard is you're recognizing profit earlier than you otherwise might. Most of your profit, in fact, here, all of your profit is recognized at the time of harvest. And if the price doesn't change, then at the time of sale, there's no additional profit. However, depending on how long it takes, up until the date of sale might change. And so you might end up having, at that date, a bigger profit, bigger than zero, or a smaller profit, a loss. Both of those are possible. Okay. So before I look at that green entry, I just want to come back to this 8,500. Sometimes in the textbook, and sometimes in some old exams, although I try to be pretty clear with this, sometimes in the textbook, you will not be told at the time of harvest what the estimated sales commissions are or the estimated cost of sales are. If you're not told what they are, assume they are zero. You cannot look into the future. Imagine you're in the real world. In the real world, you're doing this harvest on the year ended, in the year ended 30th of June 2019. You cannot see into the future. So you don't know that on the 15th of July, costs of 8,500 will be spent. You can't see that. It hasn't happened yet. When you look at these questions, think about what it's like in the real world. You don't have this second information until you actually make the sale. So if you're not told what the estimated sales commissions are at the time of harvest, then the best you can do is say they're zero. You don't have that information. Okay, so watch out for that, because I think some questions in the book are a little bit tricky like that. Okay, there's one more point that I want to make, and this is relating to this green entry. Because what I did was I said, okay, the harvest looks like this. We're going to spend 21 grand, so that's credit cash. We've got to record the inventory at 146.5. The standard requires us to do that, and the difference is going to be a gain. If you wanted to, you could break that up into two components, right? You could say, hey, the cost of picking the apples is 21. Let's just call that picking expense. And then the assets, the apples themselves, they come from 0 to 146.5. So there's a gain of 146.5. That is also a legitimate way of recording this, because you have still put the same amount on the income statement. You've split it up into two components. There's a gain on harvest of 146.5. There's a picking expense of 21. What's the net effect? 125.5. Same effect as you have up here, right? So look, I've only shown you this as an alternative. If you feel comfortable doing that, do it. I would prefer you do it this way, but both ways of doing it are right. And in fact, I think when I was a bit too freaky a few years ago when I was teaching this subject, I actually showed people about 3 different ways of doing it. But I've stopped doing that because it confuses people unnecessarily. So feel free to ignore everything in the green boxes and just look at the rest, and you'll have a reasonable understanding. Okay, so that's rocks and plants, or how do I put it? That's mining, exploration, and agriculture. Now, we have covered assets, and we've covered a whole bunch of different ways of measuring things: fair value, present value, recoverable amount. And so we've given you a reasonable feeling for how the different measurement approaches we have. We're going to see some of these measurement approaches later in the subject, but we've spent a lot of these weeks giving you assets as examples. So what we're going to do next week is we're going to talk about liabilities, and we're going to talk about recognition criteria. What happens if you can't measure a liability properly? What are the implications? And the answer is going to be contingent liabilities. So we'll be talking about that next week. And then after that, we'll start getting into somewhat more complicated accounting things that use similar principles, but have slightly more complex situations. Oh, my voice is gone. I think I was speaking too loudly. My apologies if I was. I was trying to overcome the squeaky chair. That's it for today. I hope you guys are okay. I will take a break and then I'll go through my emails later today and I'll prioritize the ASR ones. And I shall see you guys next week. We're done. Cheers. Okay, I'll just close everything up. Okay, and I am stopping the recording.